Pramod Gubbi joins us now, Vice President Institutional Equities with Ambit Capital. Pramod, good morning. Thank you for joining us. Pramod, the argument which everyone is bringing on board is that markets are going up because of liquidity. But liquidity off late is neutral. FIs are selling, DIs are buying, and yet markets are going up even though liquidity is not net positive.
Yeah, I mean, on balance, it's still positive, but having said that, you also need to look at the sort of cash holding that the domestic institutional investors have. So each time you see some sort of a correction, you will be met with some buying. So to that extent, I think the downside is sort of protected, and hence with every bit of a risk-off trade that you're seeing globally now, Indian markets also continue its journey upwards. So yeah, I mean, from a technical standpoint, I think as far as flows are concerned, they remain fairly buoyant, and that should continue unless and until we see a fairly dramatic negative catalyst coming in. We've seen a few in the past, but the markets have sort of overlooked. So it remains to be seen as to what sort of catalyst can cause that flows to reverse from the domestic market. But it is a global rally. It's not just India. Both developed and emerging markets are rallying quite strongly, and I guess we are just a part of it.
Right. Okay. Pramod, you know, we are talking this morning about the oil marketing companies and the way they came back in today's session, which was expected. There was some bit of speculative selling on the back of some rumor in the market that, you know, the government may want the OMCs to bear the brunt of oil price hikes. As an investor, as somebody who's advising clients, what do you make of this piece of news, and what's your overall view on OMCs in the wake of this whole deregulation reform that's played out?
We've been positive on OMCs exactly for the same reason, that we think that OMCs have become a fair free market play now with the deregulation of oil products prices, and on that basis there is a structural recovery in the margin profile, in the return profile of OMCs. And that's giving them enough cash flow to invest and expand. So that way, we think they've entered a new regime, or rather a break from the past. However, the risk remains that if this reverses, this whole central theme of them becoming a free market play reverses, and there's continued government intervention, that's a big risk. But personally, I doubt if the government will take such a big step backwards. It will seem regressive as far as its reform promise is concerned, and puts a bigger question mark. So I would think any sort of speculation on that front and stock prices correcting a great opportunity to buy into that sector.
Pramod, hi, morning. You know, the big debate this morning is what do you do with the underperformers, and pharmaceuticals really comes to the top of your mind. The news flow as well now seems to be changing, what with the upgrades coming in for Sun Pharma, or for that matter the price action in divvies. How is it that you approach the sector now, and do you think it's definitely worth a relook, because this is a rising market and underperformers will at some given point have to participate, and I guess the move will happen first, the reason will follow next.
Absolutely. No, I agree. I think it is a time to look at not just pharma, but also some of the other underperforming sectors, like you said. More than them participating in the rally, I think the biggest reason to hold them, particularly for relative benchmarked fund investor who's compelled to stay invested in the market, is they give you sort of downside protection. Given the sort of slew of macroeconomic indicators that we've seen, which is suggesting a weakening economy, and the lack of earnings growth, be it GST disruption or otherwise, there is concern building up in the market that the rest of the market that has rallied so strongly, which is making valuations look so punchy, requires sustenance of that earnings growth, the lack of which means that most of these stocks which have done well have significant downside risks. So on the other hand, you look at those sectors and stocks which haven't done well, from a capital protection standpoint, they sort of raise their hand for the picking. So that's in my view the bigger driver for pharma than any sort of immediate recovery in their earnings. Their struggles will continue. Pricing pressure in the US will continue. It's not going away. But having said that, much of that is baked into valuations and prices, and hence the biggest driver should be the fact that your capital is likely to be protected in that sector as opposed to some of the better performing sectors.
Pramod, another undervalued sector then is technology. Do you think it's time to play it as a defensive space, something that would protect your portfolio because the downside risk is limited? The stocks have corrected quite a bit, but there's perhaps that consolidation phase within which the stocks will not do so much. In a turnaround, of course, they can pick up momentum. So would you recommend IT as a defensive bet?
Yes, again, from the point of view that you need to perhaps protect your downside, it again lends itself to that sort of positioning in terms of its portfolio. But again, the challenges that the sector is facing is not trivial. It is significant transformation the way the industry's demand profile has changed. Yes, it's been over 2 years now. And a lot of, especially the larger companies, have managed to make investments in changing or adapting to these changes themselves. So sooner or later, some of these investments will bear fruit, and they'll be able to pick up from the sort of 6 to 8% growth profile that we've seen back to say about 10 to 12%. And sooner or later, when the rupee sort of depreciates, you will see an earnings growth of 15%. And more importantly for the sector, I think it's the sort of cash generation and the cash piles that they're sitting on, which makes them very attractive from a yield perspective, because most of them will get into buybacks and special dividends, which will add to the total return for investors. So yeah, again, the first reason is to park yourself in IT, because much of the negatives seem to be priced in. But perhaps over the next 2 years, you will see some sort of recovery in the growth profile as well.
Pramod, how real is the bounce back in pharma? Okay, we've spoken about pharma, but I'll tell you what, we've got your thoughts on pharma. I want to talk about what is going on with PSU banks. Markets, they still love to hold PSU banks, even though PSU banks now have indicated very clearly that the NPA problems are behind us. And whenever the new cycle will start, they were the first ones who will benefit. Why? Because they are sitting on cash. How come the difference between private banks and PSU banks now is at historic high?
I mean, I don't buy the fact that PSU banks are sitting on cash. In fact, their capital position is perhaps the weakest. Remember, this capital requirements will continue to increase from a regulatory standpoint. And we are not yet done with the entire NPA cleanup process. You might have seen the sort of peak of the NPA cycle, but remember, provisioning is very low, so that will mean that earnings will remain low, and that will continue to eat into the capital position. On top of that, we've only seen the beginning of the bankruptcy process. The first couple of settlements is not a good indicator in terms of the sort of haircuts that these banks will have to take on these bad assets. So as we progress through some of the larger assets, we'll get a better view of that. And if these haircuts are much more than what the market is factoring in, that'll be a double whammy, because it'll be a drag on stock prices, but also it'll pull down their capital position even more. And yet we haven't seen any sort of clear, credible plan from the government in terms of recapitalizing these banks. So first, they need to pull up their capital position to fit the regulatory requirements. On top of that, they need to build a buffer to fund growth as and when the whole cleanup process is complete. So I think we are far from making a case that PSU banks are worth looking at. But having said that, I'm not sure that gives the case for the private sector bank valuations, which are again fairly on the higher side. They're assuming that they'll continue to take market share from PSU banks over the long term, without making any sort of cyclical mistakes there. That's again a bit too much in my view.
Okay, Pramod, thanks so much for taking the time out. We'll let you go on that note. Can keep talking about markets for hours, but commercial obligations. Thanks for joining in today.